Hello, I'm Michael Thomsett, co-founder of ThomsettOptions.com. Thank you for looking in on this today. I want to talk to you about the problem of depreciated stock. What do you do when your stock loses value after you purchase it? Do you just hold on and wait, hoping for it to rebound and go back to your starting point? Or do you attempt to enact a recovery strategy of some kind? Options are very useful in creating recovery strategies. For example, when you first buy stock, you can set up a protective put or even a collar to prevent a downside loss. However, for some people, just owning stock is the starting point, and once the stock goes down in value, they seek out ways to recover lost value. Among these are recognition that prices tend to swing back and forth, and so once a stock price dips, you can buy calls to hopefully benefit from the increase in the price later on. You can sell puts, which is a little riskier, but generates income and reduces the amount of the loss. The traditional idea of averaging up or averaging down can be a lost way of trying to recover, because if the stock continues down, then the chances of ever recovering are made worse, and in fact augmented by increasing the number of shares that you hold in that situation. Many option strategies are designed to help you recover such losses. Even covered calls can work for this. For example, if you buy a stock at, say, 57 and your value then falls to 54, you've lost $300. If you can sell a covered call with a strike of 55 and get 5 points for it, you probably will tie that money up for some amount of time, but this does pay back the lost value because that option premium reduces your basis in the stock. And so even if it's exercised later, you will have a net profit on the stock and the option. That's a pretty basic recovery strategy. Another way is to set up a synthetic position. For example, synthetic long stock consists of one long call and one short put. This position tends to mirror the movement in stock, and it does best when stock rises. The nice thing about this versus buying calls by themselves is that the synthetic position costs little or nothing to open. The major disadvantage is that it does involve a short put. The opposite strategy, a synthetic short stock position, involves a long put and short call. And if you own that stock, then you are combining a long put with a covered call for no cost or very little cost. And so there's no extra risk in this position. This position, however, will do best when the stock declines in value. These kinds of strategies, contingent loss or profit strategies, recovery, no cost or low cost strategies, are all potentially very complex, and this is why on ThomsettOptions.com we have several training courses, one of which on synthetics is quite extensive, and so I invite you to go to ThomsettOptions.com and check out these different kinds of strategies, many of which are appropriate for recovery. When you buy stock, there is a tendency to think of the price you pay as a starting point or a 0 point. And a lot of traders and investors expect the stock to then go up in value. In other words, they consider their purchase price the 0 point. However, it's very important to realize that the price you pay for the stock is a continuum. The price can go up, the price can go down, or it can remain stagnant for many months or even years. And so when you pick stock and when you time your entry into that stock position, please be aware of the market risk you're taking, and also be aware of the many different ways that options can be used, not only for recovery, but also to protect your initial position by setting up certain kinds of strategies. For example, a basic covered call is no riskier than simply owning the stock. And in fact, the reason that it's less risky is because the premium from that call reduces your basis in the stock. And so it actually reduces risk in exchange for giving up the potential future profit you could get if and when the stock were to rise considerably. So there's a lot to look at in this. Thank you for watching this today, and I hope to see you at ThomsettOptions.com.